here. Nice to meet you. Want to get to know us? The world's first DeFi lease, powered by 15 years of fintech success. A novel invest now, pay whenever you decide solution that allows you to lease up to 3 times more than your current equity and to never miss the upside potential. Are you fed up with over-collateralized loans, elevated liquidation exposure, leveraged trades with lack of asset ownership, pricey transaction fees, and slow network confirmations? We got you covered. With the Nolus DeFi Lease, you can secure the current price of the desired asset and let the appreciation pay for the cost of your investment. The DeFi Lease provides up to 3 times more digital assets than any other crypto financing solution. Just choose a coin and supercharge it. Nolus DeFi Lease has significantly lower liquidation rates compared to the market average, which is the biggest risk when trying to speculate on the gains. And there is more. No early repayment fees, no monthly charges, no penalties, and no extra fees would apply, ever. Once the lease is repaid, the asset is released to you. The technological backbone of Nolus utilizes a lightning-fast Layer 1 blockchain based on the Cosmos SDK, which will handle the throughput needs of Web3 at scale. The protocol itself provides a quick, clear, and understandable experience in an ideal balance between security, accessibility, and reliability. A solution created for those who want to build their future wealth today. Wait no more. Get more. Get to Nolus.
And with that being said, welcome to the FRENS VALIDATOR YouTube channel once again. And yeah, guys, as always, please let us know if the mic is working, if the camera is doing all right. But yeah, welcome back to the FRENS VALIDATOR YouTube channel. And as you have just seen in the intro trailer, today we will talk about Nolus. And Nolus is a DeFi blockchain that is about to launch in the Cosmos ecosystem by leveraging the Cosmos SDK. And today I have the pleasure to talk to the co-founder Ivan and to the DeFi strategist Methodi from Nolus. With that being said, hello guys, how are you doing? Great to have you on.
Thank you for having us first, Yuri, and hello to the audience. We're actually doing great. We're a little, I would say, busy in the last month. We've been busy in the last month because we're preparing everything for our launch, which is upcoming in the weeks to come.
Yeah, hey everyone, and hey Yuri, really glad to be here. Thanks for the invite and looking forward to this conversation that we have today.
Yeah, likewise. And let's get right into it. So we have covered a YouTube video about Nolus a couple of days ago where we dive deeper into how the blockchain generally works. And today we will most likely or mostly look into the DeFi tools that you guys provide. And also we will dive deeper into all the DeFi strategies that are possible with Nolus. We will also dive deeper into the tokenomics. But before we do that, let us roll back for a second, because in this intro trailer, you guys mentioned that over-collateralization is kind of a problem in DeFi nowadays, since it somewhat hinders mass adoption, because in today's financial sector, you always have the case that if you go to a bank, you can get more money out of the bank than you initially deposited in order to get a loan, which is possible because you're getting KYC'd and so on and so forth. Obviously, this is not possible in crypto yet. So my question now is, do you think that for one of the biggest pain points for DeFi mass adoption is the fact that for lending, most of the times the user have to over-collateralize a loan?
Well, there is a reason loans to be over-collateralized, and I guess we won't be getting deep into this. We all know the reason. But however, the problem there is that by doing over-collateralized loans, a lot of the liquidity that can be useful stays locked and cannot be utilized. So that's what we'll try to figure out with Nolus and get the best of both worlds. Meaning by best of both worlds, I mean having some premiums from Web2 financing that is transferred to Web3 and crypto in general.
Nice. And I mean, you mentioned a couple of useful points already. Still, do you believe that we have a general problem with capital inefficiency in DeFi, also in regards to staking? And I mean, we see right now we also see a lot of counter developments to that. So we see, for example, liquid staking solutions so that users do not have to wait for an unbundling period until they can use their stake position. And now we also see with a DeFi lease kind of a counter development to the lending issue. So do you think that this is what we experience in this bear market right now, that we see protocols tackling all of these capital inefficiency problems that we have seen throughout the previous bull run, so to speak?
Oh, LSDs for sure try to cope with the problem with lock tokens in terms of stake tokens for sure, but I guess the biggest issue currently, and is we have to address it, that it's the elephant in the room, is the lack of liquidity in DeFi in general compared to what the liquidity that is currently available on centralized exchanges. So what we also want to tackle, this is one of the problems that we also want to tackle. We need to improve the user experience in decentralized finance and make it, I would say, similar or better to what centralized entities provide for this mass adoption confliction point to come first for already crypto native people, but also for the mass audience at some point.
And also to add to that, probably the cool thing about bull markets in general is that if we ignore of course the price appreciation of assets, they signal about a lot of limitations in the technology, right? So there were some chains were kind of they were oversaturated in terms of transactions. They fell to in the bull market, when you have like one, let's say, NFT project that is booming on one chain, it limits the experience for DeFi users on that same chain, especially if we're talking about Ethereum, where scalability with its stake scalability issues. So in a bear market, these are problems that you can more or less freely address and kind of prepare for the next wave of bull. Yeah, so this is what we're doing here at Nolus.
Well said. And speaking of what you guys are doing here, so as we have seen in the intro trailer, you guys want to build a DeFi lease so people can deposit their, let's say, for example, ETH into a DeFi lease, a so-called, which is also a smart contract, in order to take out more ETH after paying off the lease. So this is how the concept more or less works, but I want to dive deeper here, because suppose I want to deposit now 1 ETH into such a DeFi lease, and then at some point I want to get more ETH out of it after I paid off the lease and after the deposit covered the lease the whole time. So my question is, what precisely happens behind the curtain? So how does the other part enter the DeFi lease? So when I deposit 1 ETH and after the lease has passed, there's more ETH in this lease, right? So how does this precisely work? How did the other ETHs ended up in this smart contract?
Yeah, that's something that is pretty cool, and we're kind of proud with the technology that we're utilizing, and it's something that it's only native to the Cosmos ecosystem from our current standpoint. So what actually happens is, I'll roll back a little in order to explain how Nolus differs from other money markets that are currently available on the blockchain space. First of all, Nolus in order to be fully functional, money market only needs deposited stable coins from lenders. From there on, what actually happens under the hood, when just following your example, when you want to leverage your ETH position, is that the protocol itself provides stable coins to amplify your ETH, and those stable coins are then transferred to a different Cosmos chain, which in the first use case is a DEX, and swapped for ETH. So in the end of the day, you get your down payment, which is in ETH, and your loan in ETH, all both locked into a smart contract. But the best part here is that there's a real underlying asset, and which can be utilized throughout the whole lease while the lease is active.
And speaking of while the lease is active, I believe this is like a better question now for Meto, because I need to pay off the lease in form of an interest rate. How is this interest rate being calculated precisely?
Yeah, so basically, so the interest rate model is similar to your familiar Aave model. So if you look at the docs, more precisely, it's the one that is more smoother for the interest determination algorithm. And yeah, so basically, this interest is variable, right? But as soon as you create, you open a lease position, your interest gets fixed and remains for the duration of the position itself. So the interest rate determination is before the opening of the lease. Afterwards, it's fixed for the user.
That's very interesting also in context for my next question, because say I now open the lease at a fixed interest rate, let it be 5%. And I deposited 1 ETH, and say the ETH price is at $1,500. But suddenly the ETH price completely collapses. It goes down to 1,000. And still I'm able to pay my debts back. So I'm able to pay the determined interest rate. What will happen with this lease, even though the ETH price is dumping like crazy?
Yeah, the best part with our design is that actually the down payment you provided, your 1 ETH, and the loan itself act as collateral on top of your position, meaning that you need to reach much bigger, much lower rates in terms of ETH price in order for liquidations to start trigger. And by start triggering liquidations, I mean that liquidations won't happen once, rather than there will be first partial liquidations that will deduct partially part of your position, and afterwards until the whole position gets fully closed. But in terms of numbers, let's say that the first liquidation should hit around 40% drop of the ETH price, and the last liquidation should be triggered around 70% drop of the ETH price, compared to the market standard, where you actually take a loan only for, let's say, 60% out of the loan to value ratio of your deposited collateral. The liquidations there happen around 36%, meaning that you are much better in terms of risk management compared to other lending protocols on the blocks on the space.
Yeah, that's pretty exciting. I mean, that's a 4% difference, so definitely there's a huge difference here, which I find very interesting. But I want to dive deeper into like one aspect here, because again, you can only touch your deposited, like let's stick to the ETH example here. You can only touch your deposited ETH again, or take the accumulated ETH out of the lease as soon everything is paid off, so to say. But you position yourself as a lending alternative. And if we look at the opportunities that we see in the over-collateralized lending market, then I have the opportunity to immediately take a loan. So I immediately have liquidity. But based on what we have discussed so far, this is not the case. It's more like that I have the outlook to a loan in the future. And for me, this goes like more into the direction of leverage, actually. So what is your opinion on that? So where am I wrong?
No, you're actually not wrong. Or not wrong. If we transfer it to products that are more native to crypto users, it's more similar to margin trading rather than DeFi lending. However, the best way to describe this is with a regular lease, where you can actually let's say, for example, take a loan for a house or just to buy a car, where the ownership of the asset is not yours per se. However, you have sort of a way to interact with this asset. And once you repay the loan in full, the asset is transferred to you, and you're the sole owner of this asset. So I guess this is the best way to describe what Nolus does. But if I have to put it in one sentence, Nolus will actually give you the option to speculate with 3 times more equity compared to your current holdings, and to do that in a, let's say, very safe environment. Because let's go with an example with Atom. If you have, let's say, if you hold 100 atoms currently, you know that the price is in its lowest, and you know that there's a certain price appreciation that is coming in the next month or in the next weeks or in the next year, and you want to put yourself in a position where you want to speculate with more atoms compared to what you're currently holding. Nolus is the best fit for you, because you can have 3 times more tokens compared to your current equity, and in the end of the day, be able to repay back your loan with part of this position. Meaning, for example, if you leverage your position to 250 atoms, there is 150 in loan and 100 that you already own and you've provided as a down payment in Nolus. You can, and the price appreciates with a, let's say, twofold by that compared to the price that you've entered this lease position. You can actually use something like, let's say, 25 to 50 atoms to repay fully the loan given by Nolus. And in the end of the day, you will have 200 atoms that will be fully available in your wallet to do whatever you like with. But as I mentioned, something that it's really differentiates us from, let's say, different margin protocols or centralized, I would say, services that are already present in crypto, is that there's a real underlying asset under every position. And this asset can be utilized at its full potential while this lease position is active. But yeah, Matthew can dig a little deeper there.
Yes, 100%. And to also make this a little bit more understandable for people who might be new to this concept. So most of the exchanges that are offering a similar service in terms of margin trading, they don't do that with real world assets. They do this with derivatives. And we discussed this quite often on this channel already. Derivatives are basically a way to how to track an asset class. So for example, if you trade gold online, you are trading derivatives, and you have the same thing in crypto. And obviously there are also more things that differentiate you from the traditional margin trading platforms that also offer derivatives. I just say FTX here. So there are a lot of differences that we can touch base on. But I want to dive deeper now into what you just mentioned in terms of price appreciation. So you mentioned it quite well. So I, as a lender, can profit from ETH appreciating in price. So to stick to the ETH example here, say I deposit 1 ETH and the ETH price is at 1,000, and then the ETH price goes all the way up to $2,000. And I, as a lender, can decide to sell parts of the gains that are locked in the smart contract. I would like to pick your brain on this, on how this technically works, because if the asset is locked in the smart contract, who is basically executing the selling order? Is it the user who executes the selling order, or is it the protocol?
I guess it's the user that instantiates this transaction. However, the protocol itself, the smart contracts of the protocol are doing the selling for you. With every lease position, our smart contract factory creates a smart contract instance that is unique for every user or for every lease position. Here, the best part here is that we heavily utilize IBC and interchain accounts, and with every lease smart contracts instantiated, we'll be opening an interchain account to a host network where certain activities will happen. For example, let's say where you, just to follow your example, you want to close part of your position, and you just do 2 clicks in the Nolus web application UI, and the whole thing is handled through the smart contract itself, because it's actually giving orders to the host network what shall happen and how to swap this part of your position in what denomination you should swap it to.
You just mentioned the wonderful concept of interchain accounts. So let us dive deeper into the Cosmos aspect. So again, you are leveraging the Cosmos SDK, and you also mentioned IBC. So apparently you will also be IBC enabled. So let us dive deeper into the reasons for that. So I believe as a project that has an idea for a product like you guys with the DeFi lease, the first thing that you ask yourself when you came up with the idea is, how will we launch? Will we launch as a dApp on top of an application? Will we eventually become a parachain on Polkadot, or will we follow a completely different approach via layer 2s? So what was the essential aspect that made you decide to go with the app chain thesis, aka building a blockchain from scratch with the Cosmos SDK, make it IBC enabled, and therefore have an app chain that is focusing solely on one product only?
Yeah, well, when we started, when the product started shaping up in our heads, we started asking the same question to ourselves and did our due diligence. It was back 15 months back or something like that. And from that point then there was no option to, let's say, to have your own chain that can intercommunicate with other blockchains and have this extended functionality. We evaluated all options, like as you mentioned, just deploying our contracts on a general purpose L1. However, back then the problem with Ethereum was the high transaction volume, the low speeds. Terra had already started gaining traction. We saw the potential there and how robust the infrastructure is. Osmosis had just spun up their app chain, and we started digging a little deeper there. We saw IBC working as expected and being really production ready. And afterwards, we started reading more about and looking into all the development around interchain accounts, and guess that was the reason why we focused on building with Cosmos SDK and having IBC and ICA product ready from launch, because we wanted to create a product that it's I would say thought out for the future, meaning that we truly believe that not only app chains but the world won't be, the whole blockchain space won't be one monolithic or several monolithic blockchains, but the world will be something like having a TCP/IP protocol, just like we have in normal web, applications, and that cross-chain communication will be the way to go in the years to come. So this was one of the reasons why we opted out for this design. And the second one was that we can extract additional value for the protocol itself from the infrastructure. For example, we've created different revenue streams that will be used solely to buy back our native token from the open market, and one of those revenue streams will be deducted, a small amounts that will be deducted from all transactions done on the Nolus blockchain, which is something quite unique and we couldn't do on any general purpose L1 at the time when we were looking at all the available options. Polkadot, back then there was no way of different parachains to communicate between one another. Same goes with Avalanche. They both have some sort of solution that, in my personal experience, are not ready to go in a production environment and be as robust as IBC is currently.
Yeah, I totally agree on that. And I mean, we have seen also that Avalanche is learning from the Cosmos IBC. So the teams are helping each other to bring a similar communication standard to the Avalanche ecosystem. But as we all know today, Cosmos was focusing on IBC in 2020 and early 2021. And this is why Cosmos has this communication advantage within its ecosystem right now. But before I pass the next question to Meto, because this is, again, also about something that you just touched based on in regards to different revenue streams and buying back NLS from the open market. Before we will dive deeper into that, I would like to ask you one more question in regards of this broader vision of joining the Cosmos ecosystem. I mean, I believe there are also economic decisions for, or the economic aspects for making the decision to launch your own blockchain. For example, you have more control over your own token. You can also make more adjustments within the consensus layer, but you can also profit more from the own fees you will generate by yourself. So was this also one of the main aspects, since for you as a product owner, your product is able to generate revenue faster and more efficient? And maybe you can also touch base on MEV here real quick.
Yeah, in terms of efficiency, I guess time will tell whether this is the most efficient approach, because normally for, let's say, new products to go live, it's normal they just to, let's say, have their smart contracts deployed anywhere, and once they get enough traction to spun out their own blockchain. However, we've decided to opt out for directly spinning out our application because we saw that we can extract additional value from it, and we wanted to own our the whole block space from this layer one in order to provide a pretty quick, pretty good user experience in terms of time for transaction to be executed, and etc. etc.
Yeah, totally understandable. And now let's, I would like to pass the next question to you, Meto, and it's about NLS. So we talked about how Nolus will be its own blockchain. We just dive deeper into the advantages of it, and also people who buy the NLS token or receive them in another way, we will also dive deeper into that, have the opportunity to stake the NLS token. And you're here on the FRENS VALIDATOR YouTube channel, so we love staking. We provide infrastructure across the whole Cosmos and beyond, and we see this as a service in order to provide infrastructure for the space and, like, moreover, to secure blockchains and to secure networks. But you also view this from a different angle, because people who stake NLS can also affect their personal borrowing or lending APR. And my question now is, how can this be the case? Because again, we view staking more as a security mechanism to compensate, supporting the network security and giving up this capital efficiency that you have since you lock your tokens away. But now when staking NLS, you can either decrease your interest rate that you need to pay or increase the interest rate that you will receive as a lender. But in my book, to be honest, lending and borrowing, so the interest rates for lending and borrowing depends on the demand of people wanting to borrow or lending, or lending out the crypto asset XYZ. So I try to, like, I struggle to wrap my head around this. So could you help me with this, explaining me why staking NLS will benefit me in form of the lending or borrowing APR, even though these are two different concepts, providing liquidity, so to speak, and securing the chain?
Sure. So yeah, you got it right. And Nolus being an app chain means that the token can be strictly focused to not only the base layer, meaning securing the network, but also to the application that is living on top of that network, right? So what we are doing is that on the one hand, you as a user, you either stake to your own validator or you delegate to some existing validator in the network to provide security. But of course, this is all traceable on chain, right? So you have this information, like each wallet, how many tokens have they staked. So from that, you can pretty much define sort of a tiered staking system. And let's say that you, for instance, you have like 3 tiers. You stake 1,000 NLS, 3,000 and 10,000 for a given duration. And the longer you stake and the more you have, the more benefits you have for the money market on top. So of course, the yield for the lenders, let's say, it comes from the borrowers who are paying the interest in the active lease positions, and they get also additional yield in form of incentives. But this can be defined by the protocol to allow lenders who are also staking NLS in the system and securing the chain, for them to get more yield compared to the rest. And the same applies for the borrowers. So you can pretty much play around with that interest rate determination algorithm by tweaking parameter based on the staked value, right? So that's how it's supposed to work.
Yeah, but I just want to add 2 things here. The whole protocol is built on the thesis of cash basis, meaning that the actual interest that is gained from the protocol from borrowed assets will be distributed towards lenders. It's I would say different in terms of most money markets as a design, because they most work on accrual basis, meaning that they accrued on their books rewards. However, they distribute funds from their lending pools before the actual repayment of loans has been made. However, in order to tackle this and to have real yield going towards lenders, we've designed the protocol in a way that the interest should be repaid on a certain amount of time while your lease position is active. This way, we guarantee that there will be a stable flow of tokens that will be paying interest towards lenders.
I mean, for me, this also makes a lot of sense at first sight, because this incentivizes first people to provide liquidity because it's easy for them to get extra incentives. And for you, it also makes sense to incentivize people staking it because, of course, it makes the chain more secure, because obviously the more people stake their assets, the more secure the chain is. But it also is beneficial from a completely different perspective, which is that it will reduce the selling pressure for NLS, obviously, because people who stake their NLS can't just sell them like this, because they would need to unbond them. So my question here is this also like part of the whole concept that you say, okay, we incentivize people to stake their NLS since this reduces the selling pressure, and then borrowers and lenders lock their tokens away. They are happy about that. But on the other hand, it also drives the demand for accumulating more NLS, since it's beneficial to stake NLS, because first of all, you gain an APR for staking the NLS token itself, and on the other hand, you get advantages for example, in form of providing liquidity or getting money out of the lease. But if that's the case, what happens if this game theory does not work out entirely, and this incentivization program does not work out as initially planned?
Well, the best part here is that a couple of times we already mentioned that there are different revenue streams that will help, that will use the whole protocol revenue to help balance the case that you actually outlined. Because, for example, when we were creating the whole economical model, we saw that there could be some problems with the model. So that's how those revenue streams were born. And the whole concept there is that in order not to flood the market with a lot of tokens because of, let's say, high yields from staking rewards, we wanted to have sort of a balancing mechanism that can help out in these type of situations. And the more utility, the more people utilize the protocol, the more buybacks get traction, and in terms of amounts, they will get bigger in time. We kind of look at the protocol as a utility, as a tool. So we want to incentivize and to make people that are going to really use the protocol to have more incentive to use it. So that's why we've designed all this staking mechanism and the tiers that Matthew has outlined previously. We believe that the people that are interested in such a I would say leverage long positions will be also interested in holding our token, and as well as having more exposure rather than only 150%.
Yeah, and diving deeper into this, you mentioned the different income streams. I think this is also very important for my next question, because what I love about your tokenomics, to be honest, is that the NLS token has a fairly low inflation rate compared to other tokens that we have seen in the Cosmos ecosystem. So when we had this crazy bull market in 2021, of course, it was like super nice because prices were pumping and you got like an insane staking inflation on your tokens. But as soon as we entered the bear market, this became a problem, since there was a lot of selling pressure for these highly inflationary tokens. But here the question is, I mean, most of the staking rewards, or most of the staking APR today, gets generated because of the inflation of the native token, not because of actual fees that are being generated. So will these different income models will also impact the staking APR of the user to hold the staking APR and keep it incentivized to stake NLS?
Yeah, it pretty much actually depends on the governance decision by the stakeholders, because for the time being, the first focus will be to get enough liquidity into the protocol so that borrowers can open lease positions, and there is enough liquidity in the protocol to open lease positions. So first thing in order will be to incentivize lenders to come and stake their tokens. After time passes by and the inflation rate drops, let's say severely from what we've actually put in the first or second year in terms of APR, expected APR, It will be totally up to the stakeholders to decide whether they want to use part of those bought back tokens to be directed towards stakers, or leave them as they are currently in a position where they fully incentivize lenders.
I see. And let's dive deeper into the NLS token one last time for another aspect that is very important in the Cosmos ecosystem. So I've read that there are like different possibilities for receiving NLS. Of course, there's the option to buy it from the open market. There is the option to stake NLS to accumulate more NLS. But then I've also read the term airdrop. So what is this all about? Is there like an airdrop that the Cosmos community can look forward to?
I guess it won't be an airdrop in the manner that all the Cosmos people are used to. But however, we have something in mind that will be we'll reveal in the upcoming weeks. So stay tuned for more updates on this.
Speaking of stay tuned, what is a great method for people watching this or listen to this in the podcast in retrospect? What is a good way to reach out to you guys and learn more about Nolus?
I guess the best way to reach out to us is Discord, as our community is currently most vibrant there and most active there. However, we are also present on Twitter as well and Telegram. So feel free to follow us and join our Discord server.
And as always, guys, you can find these links in the description below as soon as this live stream is over. And with that being said, Meto, Ivan, thank you so much for joining and answering our questions. Again, if you guys want to learn more about the general approach of Nolus, then check out our recent interview. Our recent episode that was published on Tuesday, or check out the Nolus website. Today we really focused on the DeFi strategies of Nolus. So yeah, once again, thank you, Meto, thank you, Ivan, and I hope I see you on the show very soon again.
Thanks, Yuri.
Thanks, Yuri. It was a real pleasure talking with you as always.